Hi, I'm Jimmy. In this video, we're going to walk through 3 solid dividend ETFs that are all based on the S&P 500. First, we're going to compare each of the different ETFs to each other, and then we're going to look at what they invest in, what makes them unique, and then hopefully we'll be able to come up with something that will be valuable to each of our portfolios. Okay, the first dividend ETF is the S&P 500 Dividend Aristocrats ETF, ticker symbol NOBL. The second one is the Spider S&P 500 High Dividend ETF, their ticker symbol's SPYD. And then the third one is a fairly new ETF called the AAM S&P 500 High Dividend Value ETF, their ticker symbol SPDV. So the first thing I think is important for us to go through is some of the key data. And I think that this data is important to go through for almost any ETF analysis that we might be doing. So the first one is fees. Now, the Dividend Aristocrats ETF, NOBL, their fee is about 35 basis points. So that's about 1/3 of 1%. Then SPYD, they have a fee of about 12 basis points, and SPDV has a fee of about 29 basis points. Then we could jump over to holdings. Now, we know that each of these 3 ETFs are based off of the S&P 500, and they're all dividend ETFs, but we might be surprised to learn that they're not all compiled the same way. So NOBL has 58 different dividend-paying stocks within the ETF. SPYD has 81, and then SPDV has about 56. Now we jump to dividend yield. So they all pay a quarterly dividend, so that's reasonable. Then for NOBL, they have a dividend yield of about 2.5%. SPYD has almost double that at 4.6%, and SPDV comes in at about 4.3%. So now it's important to look at what types of companies each of these dividend ETFs are holding. One way to do that, at least one way to look at the value component of this, is what is the weighted average price to earnings ratio for each of these ETFs. So if we were to look at the PE ratio for NOBL comes in at about 18x. SPYD comes in at about 14x, and SPDV comes in at 12x. Now, just so we all have a benchmark for these numbers, right now the S&P 500 is trading at about 18.5 times earnings. So their PE is about 18.5x. So the Dividend Aristocrats ETF, NOBL, they're coming in slightly better than that because it's a little bit lower. While SPYD is even better, and SPDV at just 12x implies that it seems to make sense that they are calling themselves a high dividend value ETF because they appear to be a value right now. Now we can shift over to the weighted average market cap of the holdings within the ETF. So NOBL has an average market cap of $4.3 billion. SPYD is a little bit smaller at $3.2 billion, and SPDV is the smallest at about $2.7 billion. So it seems that NOBL is going after the larger, more established companies, while the high dividend value ETF, SPDV, is clearly going after smaller companies that seems to be trading at a value. We saw that because of their low PE ratio. And then SPYD seems to fall somewhere in the middle. Now, another interesting point that I came across when I was looking at each of these dividend ETFs was how much they have in assets under management. So NOBL has about $4.7 billion invested in it. SPYD has about $1.5 billion, and SPDV has just over $32 million. Now, I bring this up because I think that often there's a misunderstanding as to the importance of assets under management in an ETF. At least I misunderstood it when I first started, so I figure there's at least a few people that were in the same boat as me. Okay, so my first thought was, okay, clearly the company that manages the ETF is making their money, is bringing in their revenue based off of their fee. And in the case of SPDV, that fee is 29 basis points. So let's say they have about $32 million. That would mean that they're bringing in less than $100,000 a year in annual revenue. So I'm sure that company has expenses, but what are they? And does that $100,000 make them profitable? Do they have other forms of revenue? If they don't, what happens if they went under? What happens to the money that we invested in the ETF? Do we lose that money? Well, it turns out that if the company went out of business, or if the ETF was shut down for whatever the reason, that money would simply get returned to us. So one of the advantages of ETFs in general is that the price of the ETF is based on the ETF's holdings. So there are 2 prices for an ETF that would be interesting to any of us. And the first is the net asset value, or NAV. And then there's the actual price of the ETF that we pay on the stock exchange. usually these two numbers are very, very close to each other. So if the company that controlled the ETF went out of business and they shut down the ETF, or if they shut down the ETF for some other reason, well, the fund would actually be liquidated at the current net asset value price. So in theory, that would be what we got back minus any cost of selling the actual shares within the fund. Either way, the point is that if a ETF were shut down or a company were to go out of business, we would essentially get back the net asset value of that. So the amount of assets under management has no direct impact on the liquidity of the ETF itself. But there is something else called ETF Implied Liquidity. And this is key for any ETF if we happen to be investing a large amount of money into a single ETF. Now, basically what that is that ETF Implied Liquidity looks at all the companies in the ETF and how much somebody could buy of that ETF before they meaningfully have an impact on the least volatile company in the ETF. The least liquid company in the ETF. So since you're buying the ETF and they are therefore buying the shares of the company that are supposed to be in that ETF, how much money can you invest before you eventually start impacting the underlying companies? Now, for what we're looking at here, because the companies that are in each of these dividend ETFs are so large and they are so liquid, they're all part of the S&P 500, well, it would take a ton of money to impact the liquidity of any of the underlying holdings of these ETFs. So to illustrate that, if we look at SPDV, they actually have the highest of all the implied liquidity of these three companies because it would take more than $900 million before it would have a meaningful impact on the underlying holdings, the least liquid underlying holding. While NOBL and SPYD are both in the $700 million range. So ETF implied liquidity can be an important thing to look up. You can usually find that at the fund's site. But in a big fund like this, it probably won't matter too much. But if you were to go ahead and look for, particularly for smaller cap companies that perhaps don't trade as much, if you found an ETF that had a smaller number of holdings, it might be something to look for. Okay, now let's look quickly at the broad holdings of each of these dividend ETFs. So this is NOBL. And as we can see, NOBL is fairly well spread out amongst the different sectors where they're mostly in consumer staples and industrials. And anybody not familiar with the Dividend Aristocrats ETF, well, this ETF focuses on companies in the S&P 500. Then to be considered a Dividend Aristocrat, they must have increased their dividend every year for at least 25 consecutive years. Then they have to have a minimum market cap and a minimum liquidity requirements. And this ETF needs to have at least 40 holdings in it. These are the companies that are in the Dividend Aristocrats ETF. And one interesting point that I noticed was that this Dividend Aristocrats ETF has 58 companies in it. And of the 58 companies, 48 of them are not in either of the other two ETFs. I was surprised by that. I didn't expect to see that number being so high. So I'm a big fan of the Dividend Aristocrats ETF. It's a well-diversified portfolio. It holds a lot of high-quality names, as we saw, larger market cap names in the other two ETFs, but their dividend yield is not quite as high as the other ones. So if more yield is what you're after, here's SPYD. And once again, it's a well-diversified portfolio, except now real estate is where they concentrate. For companies to get into this dividend ETF, they must once again be in the S&P 500, but here's where it gets interesting. If you saw one of our recent videos where we talked about the truth of dividends, and then we broke out the S&P 500 into 4 quadrants ranked by dividend, and then back-tested those quadrants to see how they did against each other. Well, it turns out that the second most quadrant we found, ranked by dividend, had performed the best. But the first quadrant wasn't too far behind in most of the time periods that we analyzed. This ETF works in much of the same way as we had laid out, except they go after the first quadrant. The primary difference between our analysis and what they've done is that they excluded companies that didn't pay dividends from the entire universe, and then they broke it out by different groups. So this is a pretty good ETF. It's got a higher yield than our Dividend Aristocrats ETF. It's got a bit more exposure to real estate, which explains the higher yield, since more real estate investment trusts would be included with that. So if that's something that interests us, this could be a good place to look. Okay, then we could jump over to SPDV. Right away, we might notice that this is a much more balanced ETF than the other two. Basically, what they do is they pick the top 5 companies from each of the 11 GIG sectors, and then they rank those, they pick them according to their dividend yield and their free cash flow yield. So for anybody curious what free cash flow yield is, well, basically, we take the free cash flow per share and we divide it by the price per share. So if a company generated $10 in free cash flow per share, and then they would be trading at $100 per share, well, we take the 10 divided by 100, we end up with a 10% free cash flow yield. So if that same company, the stock price were to fall from 100 down to 50, well, now 10 divided by 50, you end up with a 20% free cash flow yield. So clearly, the higher the better for free cash flow yield. So the fact that SPDV focuses on the dividend yield and the free cash flow yield, well, it would make a lot of sense that they would be chasing both dividends and value. And I'm actually surprised that this fund doesn't have more assets in it, because to me, it looks well built and it seems like a high quality fund. Okay, so I think that each of our dividend ETFs brings something different to the table. So the Dividend Aristocrats ETF, NOBL, well, they bring size, they bring quality, they bring a history of dividend growth, which I think is a great thing. SPDV, well, they bring the value component, and they bring in the introduction of the free cash flow to the whole mix, which I also think is a great thing. I'm a big fan of free cash flow. They also go after a slightly smaller market cap, so that might be something for us to keep in mind. But if we want something sort of in the middle between those two, SPYD, well, they have more holdings, and they end up in a sort of a mid-range between the two ETFs. Plus, we saw that they have a tilt towards real estate. So if that's something that we're after, that could be a good play. So if you have any dividend ETFs that I didn't mention here that you really like, please put them in the comments below. I'm very curious to see what everybody's favorite dividend ETFs. I love looking at these to see how they break them down. I think that could add a lot of value to what we do. So if you haven't done so yet, hit the subscribe button, hit the thumbs up. Thank you so much for sticking with me all the way to the end of the video, and I'll see you in the next video. Thanks.